When cash loses its grip and property values climb, is the billionaire dad's bold claim a simple truth or maybe a dangerous oversimplification? That's the core question we're diving into today on the deep dive.
Yeah, it's a big one.
We're unpacking a fascinating assertion from someone we're calling the billionaire dad. His statement, "Don't hold money, hold real estate."
Pretty provocative stuff.
It really is, especially when, conventional wisdom often pushes us towards saving cash, having that liquid safety net.
Right.
So our mission today is to dig into the evidence that supports this view, but crucially also illuminate its potential blind spots and exceptions. We want you to walk away with a truly comprehensive, nuanced understanding of what this claim means for your financial perspective.
Okay.
Okay, let's unpack this.
That's a crucial distinction you've made there at the end. It's not just black and white.
Exactly.
What's truly fascinating here, I think, is how this perspective doesn't just offer an investment strategy. It fundamentally challenges our very understanding of what money is versus what wealth really means. It's deeper than just where to put your funds.
So it's not just practical advice, it's philosophical too.
In a way, yes. This isn't just about the practicalities of investing. It's about examining the nature of currency itself against tangible assets, paper versus physical stuff.
Okay.
The billionaire dad's claim, as presented in the source material we've looked at, it really speaks directly to a deep-seated anxiety many people have about financial stability, particularly when you see prices going up inflation.
Yeah, you hear about it all the time.
It really forces us to reconsider how we preserve our hard-earned value over time. Is cash really king? Or is it slowly, losing its crown?
That's a powerful setup.
Yeah.
So to really grasp the core of this claim, don't hold money, hold real estate, we probably need to start by setting the historical stage, right?
It definitely helps to have that context.
For centuries, currency was often pegged to something concrete, like gold. We had the gold standard.
Right. Physical anchor.
Exactly. This meant governments couldn't just print money whenever they felt like it. Their currency's value was tied, theoretically at least, to a physical reserve.
Kept things somewhat in check.
But after the world gradually moved off this gold standard, well, a monumental shift occurred. Governments gained this unprecedented power to print essentially unlimited currency.
Often with good intentions, like boosting the economy.
Sure, often with the intention of stimulating their economies. But this fundamentally decoupled currency from its traditional anchors, changing its relationship with intrinsic value. Forever, really.
And the consequences of that shift were, as you say, profound. Huge.
So what happened then?
Well, this newfound freedom in currency creation meant governments could, and often did, increase the money supply significantly. A common side effect of this is inflation.
Right, prices go up.
Which leads directly to the erosion of purchasing power. Imagine it this way. The same, say, $100 you have today will simply buy you less tomorrow or next year or 10 years from now.
It's like a silent tax.
Exactly. This silent, steady decline in value is precisely what makes tangible assets, like real estate, so much more attractive as a long-term store of value.
Because they're physical, they don't just disappear.
Partly that, and partly because their value tends to rise with inflation, or even faster. When your paper money is constantly shrinking in real terms, something physical that tends to retain its value or even appreciate becomes incredibly appealing as a hedge.
The data we've reviewed really brings this point home. I mean, our sources highlight some compelling figures.
Yeah, the numbers are pretty stark.
For instance, there's a clear, consistent, long-term decline in the purchasing power of major currencies over the past 50 years. We're talking half a century.
Not just a short-term blip, it's a trend.
Definitely not a blip. Conversely, data from the International Real Estate Federation consistently shows that real estate has a strong track record of outperforming inflation over extended holding periods.
So one goes down in real value, the other tends to go up.
It's not just an anecdote. These are figures demonstrating a significant pattern over decades.
So if we examine the historical trajectory, the pattern becomes quite clear. Currency often loses value over time. It's almost like a slow, imperceptible leak from your financial bucket, as you say.
Yeah, drip, drip, drip.
Meanwhile, real estate frequently not only manages to keep pace with inflation, but often outpaces it, acting as a crucial hedge against that erosion.
Okay, so history and the data show this trend. But why does this happen? What are the underlying economic forces at play?
Now we're getting to the core mechanics.
That's the critical question, isn't it? It's not just a historical observation. There must be deep academic and, well, scientific reasons for this phenomena.
There are. And the economic research we examine brings in some heavy hitters from the world of economics to explain it.
Like who?
Indeed. When we talk about inflation, one of the most famous names that comes up is Milton Friedman.
Okay, I've heard of him.
His impactful quote, "Inflation is always and everywhere a monetary phenomenon," really cuts to the chase.
What does that mean in simple terms?
In simple terms, what he meant is that inflation isn't primarily caused by factors like, say, greedy businesses raising prices or sudden oil shocks, though those can play a part sometimes. Fundamentally, inflation is a result of too much money chasing too few goods.
Okay, more money printed.
Right. When governments increase the money supply without a corresponding increase in the actual goods and services available in the economy, the value of each unit of currency, each dollar, euro, whatever, diminishes.
So prices have to rise across the board.
Exactly. This directly impacts your purchasing power. Your money just doesn't go as far.
And it's not just about inflation directly impacting the cost of, bread and milk, is it? There's another layer here.
There is, a crucial one actually, illuminated by the economist Thomas Piketty.
Okay, what did he find?
His insight basically that the return on capital exceeds economic growth over the long run is incredibly relevant here.
Unpack that a bit. Return on capital.
Think about it. Capital means your assets, things like real estate, stocks, businesses. If the return you get on owning these things grows faster than the overall economy grows.
Which is usually measured by GDP growth.
Right. If your assets grow faster than the economy as a whole, then those who hold capital, those who own these assets, see their wealth grow disproportionately faster than those who primarily rely on wages.
So it contributes to wealth inequality.
That's a major implication. Piketty highlighted yes. But for our discussion, it suggests a critical insight. Simply earning wages might not be enough to keep pace financially with those who strategically hold appreciating assets. It's not just about what you earn, but fundamentally what you own.
That's a really key point, owning versus earning.
And the scientific evidence, the hard data, strongly supports these academic perspectives. We see a clear statistical correlation between M2 money supply growth.
Okay, remind us what M2 is.
Yeah, M2 is just a broad measure of the money available in the economy. It includes cash, checking deposits, savings accounts, money market funds, basically, easily accessible money.
Got it. So when M2 grows.
When M2 money supply grows rapidly, we tend to see CPI increases follow. The CPI, or Consumer Price Index, is our main measure of inflation. The average change in prices consumers pay for stuff.
So more money leads to higher prices. Friedman's point again.
Pretty much. And consistently, when we look at real estate price index movements compared to these inflation rates, we find that property values tend to increase alongside, or often even faster than, the general cost of living, the CPI.
Wow. So connecting these threads, the bigger picture seems to be that an expanding money supply inherently drives both price increases for everyday goods inflation and, maybe even more significantly for our discussion, asset value growth for things like real estate.
Precisely. In such an environment, real estate can indeed act as a powerful preservation tool, shielding your wealth from that silent erosion of inflation we talked about.
The theory and the data seem to align quite well there.
They do. And the strength of this claim isn't just rooted in modern economic theory or recent data. It echoes through history, across incredibly diverse cultures and time periods.
Right. It's not just a modern finance thing.
Not at all. This isn't just a phenomenon of our digital age. History is literally littered with examples that underscore this very point.
Exactly. Our sources highlight some truly dramatic contrast cases that really hammer this home, like the late Roman Empire, for instance.
Ancient history, but very relevant.
Absolutely. We're talking about a period where the imperial government progressively debased its silver coins. They literally put less silver in them over time.
To pay the bills, fund the legion.
Right, to fund its vast expenses and military campaigns. What was the direct outcome? People rapidly lost trust in the currency. It wasn't worth what it used to be.
Makes sense.
It led to widespread currency collapse, and the direct consequence was a massive rush towards land consolidation. People desperately sought security in tangible assets, specifically land, because their money was quickly becoming worthless.
Imagine watching your savings just evaporate like that.
It makes you wonder, doesn't it? What happens when trust in a currency completely erodes? People flock to something real.
It's a remarkably timeless pattern. You fast forward many centuries, look at 1990s Russia, right after the collapse of the Soviet Union.
Another period of massive upheaval.
Exactly. The ruble experienced hyperinflation, a truly devastating crash. It wiped out cities almost overnight. for millions of people.
Just gone.
Just gone. In response, what did ordinary citizens do? They rushed into anything tangible they could get their hands on. Land, gold, foreign currencies like dollars, other physical assets.
Anything but rubles.
Pretty much.
Yeah?
It was a desperate, almost primal attempt to preserve any shred of wealth from the currency's almost instantaneous decline. The historical lesson here is stark and clear. When the perceived value of money plummets, hard assets become the ultimate refuge.
And we don't even have to look back centuries or across continents, do we? There's a more recent example closer to home for many listeners.
The 2008 crisis.
Post-2008 global financial crisis, exactly. In the U.S., the Federal Reserve implemented this program called quantitative easing, or QE.
Ah, yes, QE. Became a household term almost.
It did. This involved the Fed effectively creating new money electronically, just adding zeros to accounts to buy massive quantities of assets like government bonds and mortgage-backed securities from banks.
Pumping liquidity into the system.
Right, flooding the financial system with cash. This pushed down interest rates, made it much cheaper to borrow money.
And encouraged investment, or perhaps speculation?
Well, it certainly encouraged investment in things like real estate and stocks, leading to a significant inflation of both those asset classes. People who held those assets saw their wealth grow substantially, even as the broader economy was still struggling to recover.
So QE inflated assets, not necessarily consumer prices immediately, but assets definitely felt it.
For sure. So in both these ancient Roman cases and modern post-2008 cases, a collapse or a significant devaluation of currency, or even just a massive injection of new currency, consistently drove people toward hard, tangible assets.
The pattern is striking. It really illustrates that in times of monetary instability and devaluation, physical assets like real estate often become the preferred, maybe even the last, store of value for many.
So the evidence certainly paints a strong picture. This historical and statistical link between currency depreciation and real estate appreciation seems pretty robust.
It does build a compelling case.
It really makes you think critically about how you choose to hold your wealth, doesn't it? Cash under the mattress suddenly seems less appealing.
It absolutely does. However, and this is a really crucial caveat that we absolutely must emphasize, it's not an unbreakable universal law.
Ah, the nuance. Okay.
Yes. While the general principle we've discussed holds true across many contexts, real-world market conditions, specific government policies, even highly localized regional factors can create significant exceptions or present considerable challenges.
Like what kind of exceptions?
Well, for example, you could have a local oversupply of housing, too many new buildings in one city, or a sudden demographic shift, like a major employer leaving town, leading to population decline in an area.
Right. Local economics matter hugely.
Hugely. Or even unforeseen regulatory changes, like new zoning laws or massive property tax hikes. These can dramatically impact real estate values in a specific place, even if the national currency is inflating overall.
So location still matters, even in this context.
Absolutely. It means while the general principle real estate as an inflation hedge is powerful, applying it effectively requires careful, critical consideration of your specific environment and circumstances. You truly cannot just blindly buy any real estate anywhere and assume it will always perform perfectly without risks or downsides.
That's a vital point. Blindly following the rule could be dangerous. What are some of those other critical blind spots or downsides people need to be aware of, beyond just regional variations?
Excellent question. Because ignoring these can be just as detrimental as ignoring inflation itself. Firstly, real estate is notoriously illiquid.
Meaning hard to sell quickly.
Exactly. You can't convert a house into cash overnight, not like selling stocks or withdrawing from a bank account. It takes time, effort, finding a buyer, closing costs. It can be subject to market whims right when you might need the money most.
Okay, illiquidity. What else?
Secondly, there are significant ongoing costs. We're talking about property taxes that can, and often do, rise. Maintenance expenses, roofs leak, furnaces break, things need updating.
The joys of homeownership.
Indeed. Plus insurance premiums, maybe homeowner association fees. These costs definitely eat into your returns over time. They're not trivial.
Right. It's not just buy and hold. It's buy, hold, and maintain and pay taxes.
Precisely. Thirdly, and perhaps most importantly for anyone thinking it's a guaranteed win, real estate is subject to market cycles.
Bubbles and crashes.
Exactly. While the long-term trend might be upward, there have been, and certainly will be, significant downturns. The 2008 financial crisis saw property values plummet for years, in many areas.
Wiped out a lot of equity.
It did, impacting even those who had held property for long periods. And finally, if you're using leverage, taking out a mortgage to buy.
Which most people do.
Right. While leverage can amplify your gains if values go up, it also dramatically amplifies your losses if values decline. You still owe the bank the full amount, even if the property is worth less.
So more risks there.
Definitely more risk. These are all crucial considerations for anyone thinking of putting, as the billionaire dad says, roots in the ground.
These insights really bring us to how all of this impacts real people, like you listening. Our sources provide a fantastic, fictional, but highly illustrative case study to really bring this home.
Yeah, these examples make it tangible.
Imagine investor A who since, say, 2015, simply held their cash in a savings account. Just let it sit there. Due to inflation over that period, they would have seen their purchasing power erode by roughly 15%.
So their money buys 15% less stuff than it did before.
Exactly. Now compare that to investor B, who took that same amount of money back in 2015 and put it into real estate during that same period. According to the example, investor B would have seen a substantial 40% increase in the value of their asset.
Wow, that's a huge difference. 15% loss versus 40% gain.
It's a massive difference over less than a decade. Really makes the impact incredibly relatable and clear. Cash versus a hard asset in that specific period.
It truly highlights the silent thief of inflation on cash holdings, doesn't it? And, on a more emotional level, the source offers some important mental care advice, which I found interesting.
Mental care? How so?
Well, it suggests that if holding significant amounts of cash actually makes you anxious watching prices rise, worrying about devaluation. This deep dive suggests that a strategic diversification of your assets, perhaps converting some cash into tangible holdings like real estate, could provide genuine peace of mind.
So it's not just about returns, but also managing financial anxiety.
Exactly. It's a sobering reminder, too, that while wealth often builds slowly through consistent, thoughtful action and investment, it can vanish surprisingly quickly if held in vulnerable forms, like cash, during periods of monetary instability. It speaks to a very real human anxiety about financial security and preservation.
And we see echoes of this age-old wisdom alongside some practical counterpoints in observations that have emerged from the community, from comments and discussions around this topic.
Oh yeah, like what?
Well, there's a common saying that captures the nuance beautifully. Cash rots, land ages, but holding both can weather storms.
I like that. Acknowledges the trade-offs, the value of diversification. Neither is perfect on its own.
Exactly. And then there's the always practical, slightly cynical counterpoint. They can't steal land, but taxes will.
Yes, that brings us back to the ongoing costs, doesn't it? A very real consideration.
So it's certainly not without its own set of ongoing considerations and costs. You trade one set of risks for another.
That last point about taxes is vital, because it reminds us that while real estate offers significant benefits as a potential hedge against inflation, it also comes with ongoing responsibilities and costs that absolutely must be managed.
It's not passive income in the truest sense.
Not usually, no.
No.
However, the core, almost primal idea of land as an unshakable foundation resonates across cultures and through history. It's quite powerful. It brings to mind certain biblical narratives like the story of Job.
Job, how does he fit in?
Well, Job lost everything he had, his family, his vast possessions, his health, a total catastrophe. Yet the land, the underlying foundation of his former wealth and livelihood, it remained.
The land endured even when everything else was gone.
Exactly.
Yeah.
This powerful ancient analogy suggests that real estate represents, for many, an almost unshakable foundation. It taps into a deep-seated human need for security and stability that goes far beyond just calculating financial returns. It speaks to our fundamental need for roots, for something solid beneath our feet.
That's a truly powerful way to frame it, roots in the ground. So to wrap up our deep dive today, the billionaire dad's core claim really boils down to this sentiment. Wealth isn't just numbers on paper, it's roots in the ground.
A compelling image.
And there's substantial historical and economic evidence supporting the idea that tangible assets, especially real estate, can offer a significant hedge against currency devaluation and inflation over the long term.
Yes, but...
And it's a big but, remember, as we discussed in detail, every market has exceptions. Real estate comes with its own set of practical challenges. Illiquidity, costs, market cycles, leverage risk. It's not a magic bullet.
Definitely not. Nuance is key.
So the question for you, listening, to ponder as you reflect on this is, could the next major exception be coming? Are current conditions different? And what stands out most to you from our deep dive today? What resonates with your own experience or perspective?
Yeah, this really raises an important question for all of us, doesn't it? How do we apply these powerful historical and economic insights to our own unique situations, our own financial lives, always acknowledging that the future is never a perfect linear reflection of the past?
History rhymes, but doesn't repeat exactly.
Precisely.
Yeah.
It's about understanding the underlying principles that seem to govern wealth and currency, but remaining adaptable, remaining critically aware of the ever-changing landscape around us. So keep exploring, keep learning, and keep asking those nuanced questions.